Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and another divorce mortgage planning video quick tip. How does debt after divorce affect mortgage qualifying? Divorce can significantly affect an individual's financial situation, particularly when it comes to mortgage qualifying. Court ordered assignment of debt plays a crucial role in mortgage planning because understanding how debt after divorce is handled is essential for anyone seeking to refinance as part of the settlement process or looking to qualify to purchase a home post divorce. In today's short video, I'll explain how this affects the mortgage qualifying process and dive into other important details that should not be overlooked when drafting the marital settlement agreement. But before we get started, don't forget to take advantage and download our Divorce Lending Blueprint for Success with a link below. This free guide is designed to help walk you through the divorce lending process step by step. It is a great educational resource for both homeowners and attorneys alike. The division of debt during divorce can be just as important as dividing assets. Yet many settlement agreements unintentionally create mortgage challenges for clients down the road. Court-ordered assignment of debt may often look clear on paper, but it can expose divorcing homeowners to hidden risks that impact their ability to refinance or purchase a new home. For family law attorneys, recognizing how debt such as joint obligations, authorized user accounts, and contingent liabilities affect mortgage qualification is critical to protecting clients' financial futures. One of the first challenges arises with joint obligations, such as shared credit cards, auto loans, mortgages, or co-signed accounts. These obligations remain on credit reports until refinanced, paid in full, or removed through a novation. In contrast, authorized user accounts function differently. An authorized user is not responsible for repayment, but negative account activity, such as missed payments, will still appear on their credit. Fortunately, removing an authorized user is customarily a simpler process compared to removing a borrower from joint debt. A contingent liability occurs when one spouse remains legally responsible for a debt that has been awarded to the other in the divorce. For example, where a joint credit card or auto loan is awarded to the ex-spouse, even if the divorce decree specifies that the ex-spouse will pay it, the creditor still considers both parties liable unless the account is refinanced or paid off. While certain mortgage guidelines may allow the debt to be excluded from the borrower's debt-to-income ratios, negative activity can still impact the borrower's credit report and score. This is a critical risk attorneys must recognize when structuring settlements. What looks resolved in the marital settlement agreement can remain a lingering liability that derails mortgage approval. When dealing with court-ordered assignment of debt, divorce decrees often assign responsibility for obligations such as mortgages, auto loans, or credit cards. For mortgage qualifying purposes, a debt may be excluded from the borrower's debt-to-income ratios if there is a court order assigning payment of that debt to the ex-spouse. However, as discussed above, this does not remove the borrower's liability in the eyes of the actual creditor. If payments are missed, this would negatively affect both parties, which would include the credit of the person seeking mortgage qualifying. As you can see, this creates a hidden risk. A divorcing homeowner may believe they've been released from responsibility, only to find that joint debts continue to jeopardize their mortgage eligibility. And as a drafting tip, this is important for attorneys because the way debt is described and assigned in a settlement agreement can directly impact whether a client qualifies for a mortgage post-divorce. Precise wording is critical to help prevent mortgage qualification issues. If a divorce decree does not clearly outline who is responsible for which debts, lenders may treat all joint debts as the borrower's liability. Being able to link a specific account to a credit report is critical. Remember, credit reports do not describe accounts as the blue BMW or the green Chevrolet, but instead will reference terms of the loan or account numbers. Proper documentation of who is paying the debt improves the ability to gain mortgage approval. It is important to remember that when dealing with debt after divorce, such as joint obligations, authorized user accounts, contingent liabilities, and court-ordered assignment of debt, these have a direct and often hidden impact on mortgage qualification. These considerations can undermine even well crafted settlements if not addressed proactively. By identifying how debt is treated in the mortgage process, family law attorneys can better protect clients from unintended financial fallout, preserve homeownership options, and ensure smoother compliance with settlement terms. At Metroplex Mortgage Services, our divorce lending practice group specializes in guiding attorneys and their clients through the mortgage challenges that arise during divorce. We help avoid financing mistakes that derail settlements, maximize available equity for buyouts or division, navigate loan to value and eligibility requirements, ensure compliance with settlement timelines, and preserve homeownership opportunities post divorce. If you need a case consultation or have questions, remember that we are here to help. And to our valued family law partners, thank you for your continued referrals and trust. We're committed to supporting your clients through the complex mortgage related issues that arise during divorce. And on a scheduling note, we are actively coordinating in office and virtual presentations tailored for family law practices across Florida. These sessions are designed to equip attorneys and their staff with practical strategies on structuring equity buyouts without jeopardizing mortgage eligibility, avoiding common refinancing roadblocks tied to court ordered debt, and transaction timing with mortgage requirements in mind. Whether your firm is looking for a quick overview or an in-depth training session, we can customize the presentation to meet your needs and the unique challenges your clients face. Just contact us today to reserve your preferred date and ensure your team has the tools to protect clients from hidden mortgage risks. And before we go, don't forget to download your free copy of our Divorce Lending Blueprint for Success to keep as a resource for both you and your clients.